All right, everyone, welcome. Today, we're going to move beyond just the basic mechanics of debits and credits. We're going to put on our detective hats and investigate something that is absolutely critical for anyone who wants to lead in the business world, and that is the common errors that can silently creep into a company's financial records. Believe me, this is not just some boring accounting exercise. This is about making sure that the very foundation of your future business decisions, your strategies, your budgets, your evaluations, is built on something solid and reliable. So this is the question. This is the one every single manager, investor, and business owner has to ask. Because think about it, the financial statements, your income statement, your balance sheet, they are the language of business. They're supposed to tell us a story about how a company is doing, its financial health, its potential. But what if that story is based on flawed information? What happens when a simple, unintentional mistake leads you to a completely wrong conclusion about how profitable your company really is? Well, today we're going to learn how to read between the lines, how to critically analyze those numbers, and how to find the real story. Okay, let's dive right in. The first thing we need to do is debunk a common myth I see all the time. This idea that accounting is a perfect science and that a set of books can be totally flawless. The reality is, the accounting cycle is a process run by people, using systems built by people. And you know what that means? It means errors aren't just possible, they're pretty much inevitable. They can pop up anywhere, from the very first moment you record a transaction all the way to the final adjusting entries. So our job as future leaders isn't to pretend errors don't happen. It's to build smart systems and controls to find them and fix them fast. So if we're going to be good financial detectives, we need to know what we're looking for, right? It turns out there are some usual suspects, the same types of mistakes that show up over and over again in financial records. Understanding these common culprits is really the first step in any kind of financial investigation or audit. And these aren't just little typos. As we're about to see, each one of these can seriously warp your view of the business and, if you don't catch them, lead to some really poor, misinformed decisions. Okay, our first suspect is the transposition error. As you can see, it's exactly what it sounds like. You accidentally flipped the order of the digits. You meant to type 89, but your fingers hit 98. Or, on a bigger scale, you enter 5,400 instead of 4,500. It's such a classic, simple data entry mistake. It seems so minor, doesn't it? But let's take a look at the ripple effect a tiny mistake like this can have. Now, here's what's so tricky about this. Look at the example. A sale for $540 was accidentally recorded as $450, a super common slip-up. But notice, the journal entry is still perfectly in balance. The debit of $450 equals the credit of $450. Now, what does this mean? It means when you run a trial balance to make sure your debits and credits are equal, everything's going to look fine. A trial balance will not catch this error. So what's the real impact? Well, your cash is understated by $90, and your revenue is also understated by $90. So if you're a manager looking at these numbers, you're thinking you brought in less cash and made fewer sales than you actually did. Now imagine this happening dozens of times a month. You can end up with a dangerously wrong picture of how your company is actually performing. All right, our next culprit, incorrect account classification. I want you to think of your company's chart of accounts as a big, perfectly organized filing cabinet. You've got a specific folder for every single thing. A folder for rent, a folder for sales, a folder for office supplies. This error is like taking a really important document and just sticking it in the wrong folder. The information isn't gone, but it's totally misplaced. And that can be just as bad for our analysis. So let's really think through the real-world fallout from this. You get the company's $1,500 electricity bill, and the bookkeeper accidentally codes it to office supplies expense. Now what happens? Your financial reports are going to show that your utilities expense is $1,500 lower than it should be. The department head might even get a pat on the back for saving money. But at the same time, the report shows you spend an extra $1,500 on office supplies, so the office manager is getting grilled about why their budget is completely blown. See the problem? You as the leader are now making decisions based on a totally false story. Maybe you cut the office supply budget next quarter, punishing the wrong person, all because of one simple classification error. It completely messes up your understanding of where the money is actually going. And finally, we have what might be the sneakiest suspect of all, the ghost in the machine, the missing journal entry. This is when a transaction actually happened, a customer paid you, you paid a supplier, but it just never, ever got entered into the accounting system. It's like it just vanished into thin air. This is often the hardest one to find because there's no wrong number to look for. There's just nothing. No paper trail, no misplaced file, just a blank space where a transaction ought to be. And this quote just nails the danger here. Let's say you just launch a new product and you make a huge $20,000 sale. But if that sale never gets recorded, it's not just that your profit looks lower. Think about it from a decision-making standpoint. You look at the product's performance report and you see disappointing sales numbers. You might think the launch was a total flop, you might decide to pull the marketing budget, or even worse, discontinue the product line entirely. An entire, massive strategic decision could be made based on the absence of information. That's how dangerous a missing entry can be. Okay, so we know what we're looking for, but how do we actually catch these guys? Well, the good news is accounting gives us a standard set of investigative tools. And I want you to think of these not as just boring administrative tasks, but as your primary weapons for ensuring financial integrity. So let's open up this detective's toolkit and see how these procedures build on each other to create a system of control. Each one of these steps is like a layer of defense. First, you start with the source documents, the actual invoice, the receipt, the bank slip. This is your ground truth. It's about tying every single number in your books back to a piece of real-world evidence. Second, the trial balance. That's your first big check to make sure the fundamental rule of accounting, debits equal credits, is holding up. But we already know that won't catch everything, right? That's why step 3, reconciliation, is so incredibly important. A bank reconciliation forces you to compare your books to an objective outside source, the bank statement. This is where you'll often catch those missing entries or transposition errors. And finally, and this is key, any difference you find, no matter how small, has to be investigated until you know exactly what caused it. Now, finding the error is only half the job. As professionals, we can't just take an eraser to the books or hit the delete key. We have to fix the record formally, using something called a correcting or adjusting journal entry. And why do we do this? Because it creates a clear, transparent audit trail. It's a breadcrumb trail that shows any future auditor, manager, or investor exactly what the original mistake was, why it was wrong, and precisely how it was fixed. This maintains the integrity of your records for the long haul. And look at this chart. This is where the rubber meets the road. The company's books initially showed a net income of $55,000. Not bad, right? But then, our detective work, maybe a close look at all the invoices, uncovered a missing expense. A big $15,000 contractor bill was never put in the system. After we make the formal adjusting entry, the real net income is now $40,000. Now just stop and think about the implications of that one fix. A banker who's thinking about giving this company a loan is going to see things very differently now. An owner who thought they had 55 grand to play with now realizes they only have 40. The correction gives a much more honest and sobering picture of the company's real financial health. And this really brings us to the big takeaway for today. This whole process, finding and fixing errors, it's not just about being a bean counter or getting the books right. It's about transforming data that could be misleading into intelligence you can actually rely on. This is the critical bridge from just doing accounting to actually making smart managerial decisions. It's about making sure the story your numbers are telling is the true story. Because pretty much every major business decision you'll ever make is going to be based on this financial information. You see, when your numbers are right, you can actually measure performance against your goals in a meaningful way. You can build strategic plans based on reality, not wishful thinking. Your budgets and forecasts become powerful tools, not just wild guesses. And as you can see here, it's absolutely crucial for maintaining the trust of everyone who has a stake in your business. Your investors, your lenders, your own employees. They all count on you to give them an honest and transparent view of the company. And it all starts right here, with the commitment to getting the numbers right. So I want to leave you with this final thought to chew on. As you move on from this class and into your careers as managers, analysts, and leaders, I want you to promise me you won't just blindly accept the numbers you see on a spreadsheet. Question them. Understand the systems that created them. Because your ability to tell the difference between a simple, meaningless error and the powerful story of a true financial insight, that will be one of the most valuable skills you ever develop. It will define how effective you are as a decision maker, and ultimately, it will determine the success of your business. Okay, that concludes our discussion for today.